In a famous investing experiment, a group of 10-year-olds were asked to pick stocks and compete against a room full of highly educated chartered accountants. After 5 years, the results were in. The portfolio picked by the children actually outperformed the professionals. How did they do it? The kids did not use complex math or complicated financial models. They simply picked the consumer companies they knew and loved. They picked the companies making the entertainment they consumed, like Disneyland, and the brands making the toys they played with every single day, like Barbie. The kids won because they understood the products they consumed. You do not need a finance degree to see when a business is doing well in the real world. Buying a stock is not gambling, and it is not a lottery ticket. It is exactly like giving money to a friend's business in exchange for a slice of their future profits. A share is literally a tiny fractional piece of legal ownership in a real-world business. And the stock market is simply the digital place where millions of people go to buy and sell these ownership slices every single day. Here in India, this means you can own a piece of the massive companies that build the nation, like the Tata Group, or the companies manufacturing the motorcycles you see on the road every day, like Royal Enfield. Your biggest advantage as a beginner is right in front of you. You can look at your driveway, your pantry, or your phone to identify which businesses are winning. But what if that one company you invest in goes bankrupt and disappears? That is a very normal fear. To protect yourself, there is a strict rule you must follow. Never put all your cash into a single company. This diagram shows 10 different investments. Spreading your money across multiple companies keeps your savings stable and growing, even if one business fails. If picking individual companies is too much work, buy an index fund, a pre-made automated basket of top companies. Spreading your money out is called diversification. It ensures your overall wealth survives and grows, safe from the failure of any single idea. People often think you need to be rich or have thousands of rupees saved up to start investing. Let's see what happens if you start with a commitment of just 1,000 rupees monthly. This is the snowball effect. First, increase your monthly amount by 15% each year as your salary grows. Second, secure a 15% return over 25 years. That tiny 1,000 rupee habit compounds over time into 1 crore rupees. Wealth in the market is built through the mathematical magic of small, consistent habits multiplied by time. That timeline requires discipline, bringing us to the psychological trap that destroys most beginners, the desire to get rich quickly overnight. Treating the stock market like a casino, buying cheap penny stocks, or day trading is a guaranteed way to lose your money. The daily red and green arrows flashing on the news don't matter if the underlying business you invested in is solid and selling more products. True investors have the discipline to ignore the daily noise. You set your portfolio and let the businesses do the hard work of growing over years, not days. So, what do you actually need to do today to get started? You only need a PAN card, an Aadhaar card, and an active bank account. With those ready, you can open a trading account entirely online through modern discount brokers. This process takes only 3 to 4 days, involves zero physical paperwork, and these brokers charge near zero commission fees. Time is your greatest asset in investing. The sooner you plant the seed, the bigger the results will be. With small monthly investments, a diversified basket of familiar brands, and a patient mindset, you are completely ready to step into the market and build your financial future.